The first 3 months of excitement, then silence. The emotional arc of a new investment. Introduction. Many investments follow a recognizable psychological pattern. Month 1 to 3, intense excitement. After month 3, silence, boredom, or emotional withdrawal. This pattern is less about markets and more about human behavior. Investors often mistake emotional intensity for progress, and silence for failure. This research explores why the first 3 months feel powerful, why the silence phase follows, and what it means for long-term performance. 1. Phase 1. The excitement window, 0 to 3 months. 1.1 Dopamine and novelty. New investments create stimulation. Research phase. Entry timing. Price monitoring. Social discussion. Novelty activates reward systems in the brain. Gains feel amplified. Even small movements seem meaningful. The investor feels engaged and proactive. 1.2 Narrative reinforcement. During the early phase, confirmation bias is strong. Investors seek information that validates their thesis. Behavioral research by Daniel Kahneman shows that humans naturally favor confirming evidence over contradicting data. In the first months, positive news feels significant. Volatility feels temporary. Conviction feels high. 1.3 Identity attachment. The investment becomes part of personal identity. I found this early. I understand this better than others. Emotionally, the position is no longer just capital, it is self-expression. 2. Phase 2. The silence after month 3. Around the 3rd or 4th month, emotional intensity declines. The reasons vary. Price stabilizes. Growth slows. News cycle shifts. Market attention moves elsewhere. The investment becomes quiet. 2.1 Boredom as a psychological threat. Humans are not wired for long periods of inactivity. In markets, boredom often triggers action. The investor starts asking, is there a better opportunity? Why isn't this moving? Am I missing something? Ironically, the absence of drama feels uncomfortable. 2.2 Attention migration. Markets constantly present new stories. When a new trend emerges, attention shifts. Historical cycles, such as the aftermath of the dot-com bubble, demonstrate how capital rotates rapidly from one narrative to another. Silence is misinterpreted as stagnation. 3. The financial reality of silence. Silence is often neutral, not negative. Compounding is usually invisible in short windows. As long-term investors, like Warren Buffett emphasize, wealth is built quietly over time, not through constant excitement. Many high-quality businesses experience long flat periods before significant appreciation. 4. Emotional misinterpretations. Investors commonly confuse low volatility with weakness, sideways movement with failure, reduced news flow with declining value. But markets move in cycles of attention and neglect. Sometimes silence is accumulation. Sometimes it is digestion. 5. The critical decision point. After the first 3 months, investors face a subtle choice. Chase a new story. Stay with the original thesis. This is often where long-term performance is determined. Many sell not because fundamentals changed, but because excitement disappeared. 6. What silence teaches. The quiet phase trains patience, emotional regulation, reduced screen dependency, thesis-based evaluation. If an investor can endure silence, they often gain clarity. Markets reward endurance more than stimulation. Conclusion. The first 3 months of excitement are emotional. The following silence is structural. Excitement feels productive. Silence feels uncertain. But in long-term investing, growth is often quiet. Compounding is often boring. And patience often feels like nothing is happening. Sometimes, the silence is not the problem. It is the test.